Today we'll be presenting income tax versus wealth tax. So first of all, let's just inform ourselves a little bit. In this world, nothing can be for certain except death and taxes. This is what Benjamin Franklin once said. And no matter what we do, taxes are always going to haunt us. That's what I said. So some of you might be asking yourselves, why are we comparing the income tax versus the wealth tax? Why does it matter? What is the wealth tax anyways? So to give you a summary for that, taxes are unavoidable and necessary for the development of our society. Around the world, each country has their own form of distributing the governmental expenses throughout their citizens. This is done through different tax systems, and well, it all depends on the type of country it is. If it's a democracy, if it's a communist country, well, it all depends what countries decide on their citizens. And the citizens are dependent on those systems as well as the operation of the government. So what we need to know today is the difference between income tax and wealth tax. The income tax is focused on taxing only your income, and it can be done through many ways. One of them being the progressive tax system that the United States implements in its country. So first of all, wealth tax can also be called net worth tax. It's also called by that because it's a tax on all the net worth you may have of an individual, and one of the best examples of it is France. And some people want to implement the same system France is having on their country. So in this article, it is explaining what a wealth tax proposal from Elizabeth Warren would do. And it accesses her plan on giving a 2% tax to those with a fortune above 50 million and a 3% tax to those with a fortune above 1 billion. Two economists are designing the proposal with her, and they claim the taxes would affect only 75,000 families and raise $2.75 trillion over the course of 10 years. That sounds really good, right? This would affect their property, their stocks, whatever they own, and it may give them an incentive to revoke their U.S. citizenship and leave the country. Because of course, who wants to get taxed on so much? You're making capital, you're spending your time working, and still you're getting taxed more than the rest. Some people don't like that. And as we're going to talk about later, France is one of the best examples because so many people have left France because of that reason. So this article is based on, it's biased, but it does state where it got its information. It also tells us the downside. So in 1990, there were 12 countries for the Organization for Economic Cooperation and Development that had implemented a wealth tax. Today, there are only 4 countries, which are France, Norway, Spain, and Switzerland. I'm going to show you the other article. It's a summary and not the complete report, but this executive summary states the decreasing interest worldwide for wealth taxation. And the reason for eliminating that net wealth tax is justified because of low tax revenue. They are not able to reach their goals and administrative concerns. Why? Because it's very difficult to spy on all the rich people and look on where they're moving their money. And it's less equitable and distortive since taxpayers are taxed on what they have and not necessarily on what they are earning from their assets. So as a summary, this tells us, without going into so much detail, that it's a bad idea to be taxing the wealthy citizens or just citizens in general. There are even suggestions at the end that if you choose a wealth tax, you should consider lowering the taxes through some of the recommendations. And then there's this last article. So after that website, I came to this website called thestreet.com. And for this article, the advantages and disadvantages to the wealth tax were mentioned and some points that I didn't think of. So I just want to tell you a summary about that. It was mostly about, on the pro side, it can reduce pools of stagnant wealth to encourage people to use their capital before it gets taken away. It can reduce inequality, and the author of this article claims that it will allow the government to reach more of the richest wealth. I don't consider that to be so correct because the rich people that have the money can have the option again to leave the country and sell their properties and be gone. Some of them did that, and there's plenty of examples with France how thousands and thousands of millionaires have left the country. And the other article is Tax Journal, which is an opinionated article on why wealth tax should be implemented in Britain to counter the growing inequality. It's more on that side of things. They think that besides all the other taxes that are in Britain, one of the most heavily taxed places in the world, they want to implement a wealth tax on top of that. And it states the pros and cons on each side, but it's more on the side that they need a wealth tax to counter the inequality. Now, as I was saying, France. So I have three major findings through country examples: France, the United States, and Greece. And starting off with France, France implemented a wealth tax in 1982 by President Francois Mitterrand, which was their first socialist president. It was later abolished 5 years later by another president, but put back in place a year later. And since 2000, this is data from FT.com, there have been over 60,000 millionaires leaving the country. 60,000 millionaires. So if each millionaire had $1 million, then you're losing $60 billion. That was one of the biggest points that I said, there's really no comparison here. You're comparing having more of your money taxed, more of your assets taxed, or having less of it taxed. And I think it's very obvious for the citizen that taxing more is not good for anyone. Here's the article where I got that from. So as it says, last year alone, just in 1 year, 12,000 millionaires left from France. Another article I seen that's important in this investigation was this one, where old money, new money flees France and its wealth tax. It's an old article from 2006, which is, well, it just gives to show you that even back then it was a big problem. And there, on the second page, it shows a very important quote. Here it is. So Eric Pinchet, the author for French Tax Guide, estimates that the wealth tax earns the government about 2.6 billion a year, right? But it has cost the country more than 125 billion in capital flights in 1998, and this was in 2006. So in 8 years, they're losing 125 billion dollars and only getting 2.6 billion back. It's definitely a terrible business decision if you ask me. So looking at the United States does not have a wealth tax, but it does have an estate or death tax, as some may call it. This tax may be a little bit similar to wealth tax because you are getting taxed on the assets, but you are not getting taxed at the moment you are alive. You're being taxed once you die. And this estate tax, it hurts the most. Farmers are hurt the most because once they die, the farms that they have worked all their lives are taxed when passed on to their spouses or their children. And they may not have the money at the time to pay those taxes, so the farms are auctioned off and bigger companies buy those farms. And I think this is an unnecessary tax. I don't have the numbers as to how much they gain from that tax every year, but what I do have is some numbers on the progressive income tax system the United States have. And I can tell you that 97.2% of all income taxes come from upper half of the taxpayers. So in the US, that means that the top 50% pay for 97.2% of every US citizen's taxes. And I got this from this website called Tax Foundation. So you're looking at a different system here, way different than France. And it works out for the US. They're getting most of the money from the rich people. This is helping everyone else that is on food stamps, the government jobs, the roads, and it's all being paid by the people that have the most money, because it's fair. I think it's fair. You don't need the wealth tax when you're getting all this money to finance the government just from the income tax, and it doesn't draw any investors away because it's fair. It's all on how much money you make. So focusing on Greece, we're still comparing the income tax versus the wealth tax. Greece has had a more difficult problem than the other countries. They were heavily affected by the 2008 economic crisis, and ever since they were also having plenty of trouble with tax evasion. They didn't have a very strong institution like the IRS the United States has, and they have always had trouble managing the influx of taxes from their citizens. Tax evasion is common, as I said, so once this whole situation, this crisis came up, they took some drastic moves like trying to get out of the EU and establishing also a wealth tax, which was a tax like the most extreme wealth tax I've ever investigated in. You would get taxed on everything you owned, even the rings, gold bars you would have, your house, your watch, all this stuff that I don't think is necessary for as a wealth tax. How come they got to see everything you got? And this severely harmed the economy and led to people leaving the country and poverty going up like crazy, unemployment, brain drain, and well, I can compare these things to France. France has a severe brain drain. Hundreds and thousands of millionaires are leaving the country, and innovators, doctors, and everyone else that wants to make money is determined to leave the country and find somewhere else to work because they are going to earn more money outside of the country, like in Belgium or England or anywhere else. And that's why so many French people have left the country. And Greece is doing the same thing. They're imposing a higher wealth tax, and this is leading people to leave the country, and it's harming the economy. So just imagine how many billions of dollars France has lost from the wealth tax. I don't have the number for Greece, but if you're in a worse situation, you have a terrible economy, getting the wealth tax off is probably a good idea. So put all that together, you have the progressive income tax, you have the wealth tax in France, with a good economy, a strong economy, with some problems, but it's still strong, one of the strongest in Europe. And then you have Greece with a smaller economy, with trouble, with a financial crisis that has been looming and moving and destroying the lives of many, many people. And my conclusion is a wealth tax serves as a negative reinforcer. Use it or lose it, which coerces the productive loss of use of assets. So this is a quote, but it taxes capital, it taxes everything you got. It forces people to leave the country. And this is another article. Eric Pinchet, I already talked about this on the website. Eric Pinchet, author of a French tax guide, estimated that the wealth tax earns the government made was $2.6 billion in France, but it cost them more than $125 billion in capital flight since 1998. Well, that was my presentation. I hope you enjoyed it. Thank you.